Oil prices under pressure this morning after OPEC Plus announced that its next meeting is going to now be held online November 30th. It was initially meant to be in person, but was delayed. Now, the move did raise some concern here among investors. Speculation now swirling over what the production outlook is going to look like. We want to bring in Andy Lipow Associates president here, joining us for more on that. And Andy, when you take a look at the landscape, all of the reports that we have seen over the last several days, just about the fact that we have seen a delay in this meeting, that they couldn't figure out an agreement in terms of production. How do you see production policy from OPEC Plus shaping up as we look ahead to 2024?
Well, thank you very much for having me. What we've seen is OPEC Plus has been increasing their production over the last several months, and that's been led by Iran, Iraq, Angola, and Nigeria. And this is at the same time that the burden of the oil market has been falling on Saudi Arabia's shoulders with their production cut of 2 million barrels a day. So as we go forward, there's now disagreements because you have countries that want to increase production, and that's going to include the United Arab Emirates, who's gotten an increase in their quota. At the same time that you're seeing these lower oil prices, and these disagreements between Saudi Arabia and the others have led to this delay we've seen for the next 4 days.
So do you anticipate then, if we see supply cuts on one end, going into next year, but then on the other side of that, you mentioned non-OPEC countries who are looking to ramp up production as well. What does that net out for some of the price action that we're expecting to see?
Well, I think this puts OPEC Plus in a difficult situation when you see record oil production out of the United States of over 13 million barrels a day and significant increases out of Guyana. And you layer that with the potential return of Kurdish oil production if Iraq and Turkey and the Kurds can get an agreement on the export pipeline. So overall, I think over the next couple of months, we're going to continue to see pressure on oil prices. And that's really going to force OPEC Plus to either maintain their voluntary production cuts well into the first part of 2024, or actually they could surprise the market once again and announce a 500,000 barrel a day production cut.
What would that then do to the price of oil there, Andy?
Well, it certainly would move that oil price back up for WTI to about $80 a barrel and Brent for $85 a barrel, because it does show that OPEC and especially Saudi Arabia is serious about getting the oil price higher because their budget deficit is growing at these lower levels as they have an ambitious program to spend money domestically.
You know, when we think about the Fed and their policy pathway forward, this is one area that they don't have an arrow in the quiver for, because it's going to be largely driven by some of the OPEC plus countries, as well as some of those that are non-OPEC that are trying to bring up their production status, as we were mentioning a moment ago. And that's something that's going to impact prices all the way through to some of the more inflationary parts of the economy that the Fed does not have any control over this particularly. So, you know, how does that also pass through to the end prices that consumers might be paying?
Well, you're right that the Fed doesn't have control over the oil prices, but these higher interest rates that we're seeing for a longer period of time are going to result in lower demand or dampening any demand growth that we're seeing. When we look over into the European Union, we are seeing that oil demand is slowing down. In China, the refineries are processing less as a slower economy over there is impacting them. And if the consumer stops spending or slows down their spending here in the United States and buys less goods and services, of course, that's going to impact on Chinese manufacturing and the rest of the world. So from that standpoint, these higher interest rates for a longer period of time are bearish on the demand side.
Andy, when it comes to who's best positioned now within the energy sector as we look ahead to the next several months, is it the large energy players that have been investors' favorites when you take a look at Exxon, Chevron, especially in light of the recent acquisitions that they have made? Or are there maybe some smaller players that are more positioned or in a better position to benefit given the dynamics that are at play?
Well, certainly Exxon and Chevron have seen all the news headlines with their major acquisitions. And what we have seen is oil producers as a whole are doing more with less. The Baker Hughes rig count is down about 20% compared to this time last year. as oil production continues to rise. But there are still a number of smaller producers out there, such as Diamondback Energy, who are operating in the oil patch. And there is, of course, people thinking that perhaps we could see additional consolidation in the Permian Basin.